You are listening to Governance 360, a Link Group podcast hosted by me, Lindsey Doud.
Hello everyone, and I'm delighted to welcome you to our next Link podcast. Joining our internal capital markets expert Kit Atkinson, today we're delighted to welcome Charlie Walker of the London Stock Exchange, and we're going to be exploring today the London Stock Exchange as a listing venue of choice. Charlie is head of equity primary markets for the London Stock Exchange. He's a capital markets specialist with over 11 years of experience working in JP Morgan Cazeneux's equity markets team, where he's responsible for originating and executing equity transactions.
Hello.
Welcome, Charlie.
Thank you very much. Thank you for having me.
So perhaps you could just give us a bit more flavour for what you do at the London Stock Exchange within your job title.
Yeah, absolutely. So we have a team which I'm responsible for called the Equity Primary Markets team, and our team has a few functions. Firstly, we help private companies that are on the journey to going public. So we're often meeting with them 3, 4, 5 years ahead of an IPO to sort of help them normally gather information on what the IPO process is and what public markets are like in London. We also then maintain relationships with our existing listed companies, and we now have built an issuer services platform which helps us maintain some of those relationships. We help launch projects on behalf of the exchange, and we work with other teams within the exchange to help do that. So the London Shanghai Connect project is something that launched about 3 months ago or so now, so we were heavily involved in that. And then finally, we feed into any consultations or anything that we think is going to impact public markets in the UK. So that could be regulatory changes or corporate governance changes or anything like that. And we work with our government relations team and with our regulations team within the exchange to make sure that our voice is being heard in those debates.
Thank you. So if it's okay with you, Charlie, we're going to run through various questions.
Yeah.
We're delighted for your thoughts and insight on these topical issues. So just looking in terms of the appetite at the moment of companies certainly there's a lot of acquisition going on in the UK at the moment. UK companies are seen as attractive targets. But in terms of companies actually listing on the London Stock Exchange, what do you see as the key benefits, particularly from an international perspective?
So I think in the conversations that we have, companies typically are looking for a few things when they're looking at listing. They want to access capital markets where there's global liquidity. And on most metrics, the London Stock Exchange is one of, if not the largest exchange, certainly in Europe, and one of the top 3 exchanges in the world. So in the first half of this year, we had $25 billion of capital raised, and that was just behind the two US exchanges. So that's quite an important feature for companies looking to access the markets. We have at the moment just over 2,000 companies listed on the LSE, and they have a market capitalisation of just over £5 trillion. So it's that is a very large pool of capital for companies to access. I think from an international perspective, the thing that continues to attract those companies to London is actually London is just a hugely international place to do business. At the moment, about 40% or just under 40% of the companies on the LSE don't have their primary operations in the UK. That's one of the highest constituencies of any exchange in the world. If you look at where the earnings are generated, the FTSE 100, now 70% of the earnings are generated outside of the UK. So what it means is that when companies are bringing their stories to London and they're meeting with investors, investors aren't reluctantly investing in these businesses that may have operations in Africa or the Middle East or China. It's quite the opposite. They're meeting with investors who are often managing global portfolios, who have an active interest and desire to invest in these international locations, and so that is quite a big draw to London. I think what we also tend to find is that when companies are coming here, I don't think you can underestimate the regard in which the regulatory framework is held in the UK. The certainty of a regulatory framework that is transparent and that is seen to be fair is a huge draw to companies. And the the number of companies we've been seeing come from international locations into London has certainly been very strong. In the first half of this year, 3 out of the 5 largest companies that IPO'd on the exchange were actually international businesses. So that's not a trend that we're seeing sort of going anywhere. We think that's going to continue to build. I think the other aspect in terms of just the international nature of London is actually also the willingness to partner with other markets. And that is a key differentiator versus other markets around the world. And again, when I say markets, I don't actually mean just the exchange. I mean government and the regulator and the exchange and the advisory community as well. The London Shanghai Connect project is a prime example of that. So that we started working on that 4 years ago. That was initially actually instigated by the British government and by the Chinese government, who tasked the exchanges to go and build or explore a link between the two markets. It's required cooperation with the FCA, with the Chinese regulators, and indeed with ourselves and the Shanghai Stock Exchange. And it's for the first time ever that a non-Chinese company is able to list their share directly on to the Shanghai Stock Exchange. And that share can be traded in renminbi. It can be bought by investors in China, free of the normal capital controls that are applied. And likewise, it's a two-way program. So companies that are listed on the Shanghai Stock Exchange can, for the first time ever, list their A share onto an international market, and it's the same share. We use the GDR structure in London, but it's an A share that underlies it. So investors are able to purchase a share in London, and they're able to instruct their broker to sell that same share for them in Shanghai, and vice versa. And that is an enormous project. We had the first company use it, a company called Huatai Securities. They used it on the launch day of the program, which was in the middle of June this year. So it's a relatively new program. And they raised $1.7 billion of capital alongside it, which at the time was the largest capital raised by a Chinese company globally, outside of China. So it's a big project, and I think it's a good example. And we see dual listings with other exchanges a lot, right? We've got a lot of London TSX dual listed companies, a lot of London, Johannesburg dual listed companies. We're working with Kenya at the moment on their privatization.
ADRs, New York.
Yeah. So I think we certainly take the view that we're very happy to partner with other markets to the benefit of both capital markets. And I think that's something that has stood us in good stead.
I mean, the one other thing that I had in mind was the concentration of practitioners. There's a required critical mass to support the network of advisors, lawyers, accountants, and they do see London certainly as a European hub, if not a global one.
Yeah, I think that's right.
And that's across industries, across sectors as well. There's just that required specialisation here, particularly for those niche markets, resource-focused companies. And
you're right. I think there's an efficiency point as well. If you're doing an IPO roadshow, you'll typically go to London, New York, Boston. It's extremely efficient for a business to be able to access not just the advisory community in London, but also actually a huge amount of the investor community. Even if they're global funds, they will typically have offices in London with representatives in London.
And of course, you've got cultural differences at play as well, particularly with regard to European markets. The UK, the Anglo-Saxon model, is based around an equity investor community as opposed to a debt-driven one.
Yeah, that's right.
So it makes sense. You're raising equity. You do it in London.
Yeah, that's certainly what we're seeing at the moment, and we hope continues.
So this, just to draw on what you some of the comments you've just made, Charlie. Interestingly, particularly, I'm thinking around the regulatory framework and the concentration of advisors. Yeah. So, how would the London Stock Exchange, or how does it seek to differentiate itself from the main competitor exchanges, for example, the New York Stock Exchange?
Yeah. So I think there's a few differences. So. For starters, we tend to take the view at the LSE, and I think this is a view that has been developed over decades, if not centuries of history now, that a sort of a one-size-fits-all model doesn't necessarily work. and you need to have bespoke offerings to suit different companies in different situations. And this is on the equity side and on the debt side. And it's unusual that it is so developed. I think if you look at most international exchanges, the plethora of offerings that actually exist in London doesn't necessarily translate into other markets. So as an example, we have our AIM market, our alternative investment market, which is focused purely on small and mid-cap growth companies. And that recognises that those companies need a different set of rules and investors and advisors than necessarily large cap companies do. If you look at on the debt side, if you look at ISM, for instance, the international securities market, again, that's a new debt offering. That's a new debt market that the exchange launched 2 years ago now, which has been very successful, recognising that not all companies want to issue debt in the same way. And you need to have a couple of offerings there. We have the specialist funds segment. We have a huge funds business. It's now 150 years old on the LSE, and that was designed to provide issuers of funds with another choice in the market. Even if you look at the main market, we've got the standard segment and the premium segment. And so I guess we take the view that different investors want to be able to invest in different types of companies at different points in their life cycle, and therefore having one market which is homogenous doesn't necessarily serve everyone's purposes. And I think that's definitely a key differentiator of London versus any market actually around the world. I think I can't think of many that have that same sort of proliferation of offerings. We've spoken a little bit about it previously, but I also think that the international nature of London is a key differentiator versus any other markets. And you mentioned New York. I think that's true there as well. If I take the US as an example, if you take the S&P 500, 67% of their earnings are generated in the US. Like I say, 70% of the FTSE 100 earnings are generated outside of the UK. So it's almost an inverse relationship. If you look at investors that invest in stocks listed in the US, 85% of them are physically based in the US. Right, so it's US and fund managers.
The scale of the market makes it more naturally insular.
Yeah,
but of course, London's had to be outgoing, coming from what is a relatively small.
Yeah, that's right.
Country.
In many ways, they haven't needed our capital. It's a huge market. In London now, it's just ticked up below 50% actually now of LSE shares are held by UK-based fund managers. Again, it's diversified internationally. So I think that's sort of a key differential between us. I think also, we're talking about the London Stock Exchange, but actually, we benefit hugely from an entire system and ecosystem that exists here. It's, this is not just the London Stock Exchange, right? If it weren't for the network of advisors, the regulatory landscape, government initiatives,
infrastructure
providers, 100%, absolutely. It all works together, right? And the LSE has its part to play in that. But I don't think at any point in time does everyone think, London is a home for equity capital just because of the exchange, right? We've got a part to play in that.
Thank you. And again, really drawing on some of the comments you touched there on AIM. So how does the London Stock Exchange look to promote AIM internationally, for example, as an alternative to NASDAQ?
So I think I guess the difference with NASDAQ is that NASDAQ serves the entire range of companies in terms of market capitalization. It doesn't necessarily have a specialization in a certain market cap, right? So there are some of the world's largest companies are actually listed on NASDAQ. Whereas with AIM, we've got this focus of small and mid cap companies, and there's a belief there that these companies need a bespoke capital markets environment in order to thrive, and that the sets of regulation and advisors that sit around those companies needs to be tailored to that community. And obviously the hope is that those companies then grow on that market and eventually move to the main market once they're of they're of a certain size. If you look at AIM as a market, it's celebrating its 25th anniversary next year. It's now got about 40% of all the companies that are listed on the LSE are listed on our AIM market. And the starting point for it was almost with a blank sheet of paper. What is the regulatory environment that these companies need in order to thrive? So you want it to be flexible enough that it can accommodate these growing companies whilst being robust enough that it provides shareholder protection and indeed attracts investors into the market, both retail and, importantly, institutional investors as well. And so it's a more flexible regime, a far less prescriptive regime, but one that still has the respect of the institutional fund managers, and that's the balance that naturally has been struck in that market. Last year, I think it was over 70% of all the growth capital raised around Europe was raised on AIM. So that is a pretty unique market. We're often asked, actually, by other exchange groups and governments, how can we replicate AIM? And the challenge of replicating AIM is that, yes, again, you've got the market, that the exchange regulates, but actually it's the entire ecosystem that surrounds the market that makes it thrive. So you have the nomad community who are licensed by the exchange and are responsible for making sure that companies adhere to their listing requirements. You have investors that have dedicated small and mid-cap funds that, if you're a small company meeting these investors, you're not a tiny fish in a big pool with these investors, right? These investors are dedicated to looking at these companies. You have an analyst community and a brokerage community that's been built up around it. So, in truth, it's quite hard to replicate, and that's why companies choose to access it. What we often hear around, particularly small and mid-cap companies, whether they're considering NASDAQ specifically or any other exchange, to be honest with you, is that trying to get the attention of fund managers, investment banks, research analysts can be quite challenging if you're not of a certain size. And I think AIM provides that home to those companies without some of those challenges.
And would you say your focus has changed over recent years in terms of specifically targeting international companies on AIM? Obviously, there's been a huge success in attracting particularly American companies to AIM, and the rules obviously accommodate that around any US restrictions, securities law restrictions and things like that. Yeah. And the infrastructure, once again, has been developed to support that. Yeah. But is that a more recent development, or has AIM got a long heritage of attracting international businesses?
So it has a long heritage of attracting international businesses, although I think what we're seeing, what we've seen over recent years from the exchange has been the prevalence of international companies coming in continues to grow. And actually, the way the team is structured, we don't divide the team up between AIM and the main market. Actually, we've now got representatives in the majority of countries that you would expect us to have representatives in around the world. And they are sector agnostic and size agnostic and market agnostic. So they can meet with a company and they can talk about holistically all of the offerings that London has from a capital markets perspective. We're definitely, though, seeing, I think particularly in the emerging markets, more interest to access London as a whole. And then once you get into the international companies accessing London as a whole, the natural talking point then goes on to, well, if you're a company of a certain size, what market is right for you? And AIM is increasingly coming up in that conversation, because I think, the international profile now of AIM, we've noticed, certainly has been growing over recent years. And I think that's something that we're quite proud of.
I mean, it's not necessarily an area for you, but and slightly off piece. But to what extent do you think companies use a listing not just as a not just as a venue to raise capital, but also as a marketing tool in and of itself. Of course, you give the LSE stamp to issuers when they join their markets. Is that something that ever comes up in conversations, or would you? Obviously, capital is a prime driver, but
it is. I think profile is something that people are very focused on, and I think that's something that there is a prestige factor that comes with being listed in London, so we certainly see that, and also what we see is and linked to that profile point. I think the desire to be in a globally recognised index for those companies that are eligible, like the FTSE, FTSE UK series, is something that is a talking point quite a lot. I think that, if you think about the trends of asset management at the moment, you're seeing quite strong flows into passive, and therefore the importance of being in a globally recognised benchmark, I think are only growing.
Yeah. I mean, I get daily emails quoting passive is massive. It's obviously a growing trend, and just by a matter of process brings a huge amount of interest as soon as you qualify for that index.
Yeah, I think that's right. I think that's exactly right. And then the other thing to note is that we also see companies that want to list in London because they want to use their listed paper as an acquisition currency. And that's something that we see quite frequently. London listed paper has been used in more countries over the last, I think since 2016 from memory, than any other listed paper globally. And this
certainly, given the flow of M&A we've seen recently, that's an amazing stat and slightly contrary probably to expectations. Is it that UK listed companies tend to do share-based acquisitions as opposed to a currency one? I mean, once again, another result of the standing of London as that global market.
Yeah, well, I think it is. I think it's two factors sort of working together. You've got companies listed in London, operating internationally, right? We've now got our companies are operating in over 100 countries around the world. It's a huge amount, and therefore they're just simply more likely to do cross-border M&A activity because they've got operations in these countries. And then it's combined with, if you're going to buy a company and you're going to use your listed paper, well, the seller has to be willing to accept your listed paper. And if you're going to be paid in shares, you want to know that the rule of law and the regulatory framework around those shares is robust. And I think you don't find too many markets around the world where a regulatory framework is as respected as it is in the UK. So I think that's another natural advantage that we have.
Thank you. And then just really looking more generally at economic climate at the moment, can you give us any thoughts as to where you see the outlook for the primary markets over the next, say, 6 to 12 months?
Yeah, I think you've seen. If you look at the first half of this year as an example, you've seen IPO activity around the world has been down 22% in H1. That translates into follow-on activity as well. Follow-on activity was down 11% in H1. Some regions have been hit sort of more than others. So IPO volumes in Europe, for instance, were down 56% in H1. And I think the reasons for these is kind of self-evident. You've got US-China trade disputes going on at the moment. You've clearly got Brexit in the UK. You've got concerns over GDP in many of the developed and developing markets. London and all that, by the way, has fared fairly well. IPO activity by capital raise is actually up 35% in H1. Driven by a lot of these international companies coming in. Now, I think the trend that we see is because of all of this volatility, you are seeing companies that ordinarily would have been preparing for an IPO wanting to see a little bit more stability. And therefore, we certainly hope that once political issues do subside, you start to see companies coming back to the market, both for IPOs, but actually also just for primary capital raises. We certainly see that pipeline building slowly but surely.
Thank you, Charlie. And finally,
and I should say, actually, sorry, the last point on that is The other thing that we have seen has been, if you look at the transactions that have been getting done, they've actually been focused at large cap end of the scale, particularly for IPOs. And I think actually that probably just goes back to this point around investor sentiment in terms of political...
but also international businesses as
and
well.
International businesses.
Earlier this year, Finabler, Network International, to name two. Yes.
That's right.
So just less exposed to Brexit as an issue potentially.
I think there's potentially that. I think also investors wanting to make sure that they're investing in liquid assets at the moment is certainly something that we pick up. So, our hope is that once, and I mean this globally, by the way, once political situations stabilise somewhat, that you see a little bit more of a reversion to transactions getting done across the market cap landscape. And again, that's something that we're starting to see build in the background.
Thank you. And final question. We know that IPO activity is significantly down at the moment, but if you are a company who is considering listing on the London Stock Exchange, what would you say are perhaps the 3 key issues that need to be addressed in terms of IPO readiness?
So I think people always underestimate how much time it takes. So I'd always say start early. I'd say leave at least 12 months is a good run up. I think getting the right advisors on board early is really crucial. People who have the right experience and are going to show the right level of dedication to getting the transaction done is really important. And I think also actually appointing advisors who you want to spend time with, or who you don't mind spending time with, because you're going to be spending a huge amount of time with them, often until late in the evening. So I think appoint well qualified, well dedicated, and advisors that you get on with is crucial. I think one of the things that we see people leaving till quite late in the day often is actually board appointments. I think identifying what the board structure is going to be in a post-IPO environment, and trying to do it early and trying to get the right people on board and giving them time to understand the business whilst you're still private, so that by the time that you get to the IPO, they're able to represent that they know the company and that they've had their time to do due diligence. I think is important. I think investors are increasingly looking at that, looking to see when were the directors appointed and making sure that the corporate governance aspect of the company is sound. I think those are all important things. I think also just making sure you've got the right level of resource internally. Mm-hmm. It does take up time. It's hopefully well worth it with the benefit of hindsight. But I think trying to staff up appropriately is a good thing to do.
Yes, but I guess the other characterise it as the start of a journey as well. The IPO is not an endpoint in and of itself. It's the start of a journey as a listed company and a start of the access to all of the benefits you spoke about earlier.
Yeah.
Well, thank you very much to both our speakers. That's all we've got time for today. So obviously, apart from Kit, I'd like to particularly thank Charlie, our external speaker from the London Stock Exchange. I think you've painted an extremely compelling case for why London Stock Exchange should be perceived as a listing venue of choice. For me, I think as well as the robust regulatory structure and the proliferation of experienced advisors in the UK, what particularly came across for me was the ability of the London Stock Exchange to accommodate bespoke offerings and to really work with the company to achieve what is appropriate for its particular circumstances. Thank you very much.
You're very welcome.
Thank you for listening. Check out the podcast description for more information on this episode's guests and presenters. And if you want to get in touch with any of us, we'd love to hear from you.